Hi, I'm Link, and welcome to Link Life Money. Inflation is still sky high, interest rates are very high, and the US and Canada jobs report just came out. US payrolls grew by 261,000 in October. This chart shows the jobs added and lost since January 2020. You can see that when the pandemic first started, there was a huge amount of jobs lost, thus resulting in unemployment that was above 14%. Since then, unemployment has gradually gone down and now is slowly ticking back up. Who knows how high it will go, but it's still at near record lows. Canada surprised many analysts by adding 108,300 jobs. Money markets see a 65% chance that the Bank of Canada would raise its benchmark interest rate by a half a percentage point at its next policy announcement on December 7th. Labor force participation is still below pre-pandemic levels. There are a number of reasons why the participation rate could be so low. But just for the record, I think that being a stay-at-home parent is the most important job in the world. I definitely think that they should be included in the participation rate numbers. So with the job numbers being so high, some analysts think that there's more of a chance that the Federal Reserve and the Bank of Canada will keep increasing rates. When the labor market is tight, wages will generally increase. U.S. average hourly earnings year over year came in at 4.7%. Wage growth in Canada came in at 5.6%. Still, I don't know anyone personally that has received this much of a raise. If a person's wage is not as much as inflation, then this can definitely impact their budget. Both the United States and Canada's economies are strong. The United States economy is obviously doing much better. Some analysts think that if Canada doesn't keep up with the US rate increase, then there's more of a chance that the Canadian dollar will fall, which could result in even more prolonged inflation. However, with the jobs report and the rise in oil prices, the Canadian dollar made its biggest jump in 12 years in relation to the US dollar. Canadian dollar posts biggest gains in 12 years as jobs surge. Housing can be a huge cost in a person's budget. A 30-year fixed-rate mortgage average in the United States was only at 3.22%. Now a 30-year average mortgage is at 6.95%. In Canada, people can generally only get up to a 5-year fixed term with a reasonable rate. So when mortgages are up for renewal, many Canadians will have to pay more per month in interest, a lot more. Let's take a look at a $400,000 mortgage example. TD's current variable rate is at 5.7%. Their 5-year fixed high ratio closed rate is at 5.44%. Interestingly, the 5-year fixed is now lower than the variable. This could possibly mean that interest rates in 5 years may be lower than they are today, but there's no guarantee of that happening. In comparison, you can see that on July 13th, the 5-year fixed was only at 5.14%. Also notice the huge change in the variable rate being at 3.3% compared to now at 5.7%. A $400,000 mortgage at a 25-year term length with an interest rate at 5.14%, that would equal a total cost of the mortgage being $707,521, including principal and interest. If the interest rate increased 0.3% to 5.44%, then the total cost of the mortgage would be $728,286. That's a difference of $20,764, which is a huge amount of money. Consumer debt, such as credit card debt, can really hold a person back of achieving their financial goals. It's a great idea to try to pay off consumer debt so you don't have that weight on your shoulders. Canadians increasingly relying on credit cards as cost of living soars. The average credit card balance was sitting at a record high of $2,121. The majority of credit card issuers compound interest on a daily basis. Rates can be 20% or more. By using calculator.net, we can see that a $2,121 credit card balance at an interest rate of 20% with a minimum monthly payment of $100, it would take 2 years, 3 months to pay off that balance, as well as $517 that it would cost just in interest. I recently was looking at buying a new microphone from Amazon. I noticed this information that said $20.31 a month or less for 3 months with a firm. Click here to learn more. I clicked there, and then it went into detail how I would be charged 10 to 30% interest rate just for purchasing that $57 item. The total repayment that it would cost me would then be $260. When shopping online or in person, you never want to go into consumer debt, for you don't want to have to pay interest because it can severely affect your financial future. With interest rates being so high, it's a good idea to try to pay off your mortgage and consumer debt. I know that this is easier said than done, but by keeping track of your budget and your net worth every month, it can help motivate you when you see your financial success continuously improve. I have a budgeting and net worth calculation video located on my channel page. The link will also be in the description below. Last week, I talked about the best credit card and how a person could get over $1,500 in cash back in only 1 year of using it. This video is up on the screen right now. If you could please subscribe to my channel or share my video, I truly appreciate your support. Save money, make good choices, and please be kind.